Good afternoon, ladies and gentlemen. My name is Don Galade from GFS Financial Advisors. I'm sure many of you have been to seminars before. I think the dinner seminar is something that everybody's probably attended at least once, and I don't know if we're going to be doing that too much in the future. So we're doing things differently now. I think a lot of what we have been doing has changed, and I dare to say some of what we've been doing may have been changed forever. With that respect, the goal for today is to give you an educational event explaining to you the need for having a financial advisor in your corner, preferably one that is a registered investment advisor or RIA, which we'll talk about. Basically, what our goal for today is to talk to you about what we do, how we do it, who we do it for, and if any of this makes sense to you at the end, maybe you can give us a call. We'll call you, either or. You can click the links that'll be there that will allow us to communicate, in which case we can have more detailed conversation and potentially do either a Skype meeting or have a phone conversation. I've been doing what I do for over 30 years, been in the industry for since 1987, I believe, and the things have changed, as I said. That being said, we do have two resources that we'll make available to folks who want to meet with us. Two different books that I have personally written, and we will send those to you free of charge if you are so inclined. With that being said, let's tell you a little bit about who we are and what we do. As I said, I've been doing this quite some time. Our office is located in Northeast Pennsylvania, outside of a town called Hazleton, which has made some national news. Maybe you've heard of it. Anyway, we have quite the interesting people on our staff with regard to resumes. Of course, we have our in-house folks where we have myself and my wife, who is the Director of Administration. And then we have a gentleman who does all of the Medicare stuff for us. And then as far as a gentleman who also helps us out with auto, homeowners, etc. And then we have a staff of folks that don't work in our office, but they work with us. And some of these folks have actually been seen on a lot of the financial talk shows and the news networks such as Fox and Friends and Fox Business. And that would be some folks that work with Gradient, to the Chief Investment Officer and the Chief Tax Specialists from that organization, who we have the opportunity of partnering with. And that enables us to help you better. Now, that being said, you know, when we talk about information, when we talk about where do we get our data from, you can be a CNN person, or maybe you're a Fox News person, or maybe you're a Bloomberg person, and guess what? It really doesn't matter where you get your news from anymore, because some of them are saying the same thing, some of them are saying complete opposites. But the point is, where do we get our advice from? We have our colleagues at work, and we have Aunt Millie, who lives down the street, who seems to know everything. But who do you trust? And that's one of the things that we're going to talk about today, and that we are going to teach you about a map. And we all know what a map is. If you're a guy, you don't use maps because it's genetic. But when we go somewhere, you know, I'm old school, so we would have to pull out the paper map. And with technology, we don't have to do that anymore. But when you planned a trip, when you plan to go somewhere, the first thing you would do is plot your course. And, you know, we kind of have this nautical theme in our office, as you can see some of the ships that I collect behind us. What we talk about is reaching your destination, helping you get to your destination, which, albeit, is either retirement or maybe it's not quite retirement just yet, that it's my daughter's wedding, or it's, you know, the trip around the world, or it's, you know, various different short-term goals that the pre-retirement. But all that being said, you need to have a map. Now, when it comes to advice, there are several different places or people or types of professionals that you can talk to. You have the insurance agent, you have the registered representative or a broker, and then you have the registered investment advisor. And in some ways they're very similar, and in some ways they are intrinsically different. And it really boils down to licensing. And not to bore you with all the different licensing, but the first thing you want to do when you are meeting with a financial person is find out how they are licensed in any of these three realms. Find out how they are compensated. Find out what their fees are. Are they commission based? Find out what types of products are they selling. An insurance agent can only sell insurance products such as life insurance and annuities, whereas the registered investment advisor can sell a myriad of stocks, bonds, mutual funds, and the registered investment advisor can be a hybrid of those, but generally works for a flat fee. And that is all explained in a person's disclosure, which you can visit GFSfinancial.com. You can see our disclosures. You can see all of the how we get paid, why we get paid, who we work for, all that good stuff for those that have the that want the legal written form of the disclosures. They can be found on their website. So that being said, there's all this data out there, okay, and there's all these words and this alphabet soup with 12B1 fees and riders, back-end load, front-end load, expenses. Sometimes they call it a fee, sometimes they call it an expense, then it's an internal expense, then it's an advisory fee. And the bottom line is everybody is seemingly trying to get a piece of your investments, is seemingly trying to get, a part of the pie. Well, that's how we get paid. It doesn't make it good, bad, or indifferent, but you should have this data in front of you before you make a decision on who you're going to use, because basically you should know how that person gets paid. Okay. Then what we want to talk about is, we've all seen these folks, right? You've seen the commercials on TV that seemingly insult your intelligence, making you think that once you've retired, everybody gets their own yacht and they're all out sailing with their laptop, checking their millions of dollars and giving you this indication that life is great. Well, for some people it is. For a lot of people it's not. And especially now, for a lot of folks, it's not. And some people are thinking, I'm not worried about my retirement right now. I'm worried about how I'm going to pay the mortgage. I'm worried about paying for my kids' college. I'm worried about buying food. There are a lot of things that you have to worry about, and there are some things that you really should pay attention to right now. It doesn't necessarily mean you got to make some big decisions tomorrow, but there are things that you should pay attention to, and some of that involves the area of what we call risk, or how much risk a person is willing to take with their investments. I could tell you that, starting my career shortly before the first crash of my lifetime back in 1987, I could tell you that the time frame for recovery has been very different. We have some stuff on our website that discuss that as well, but every time it has taken, several years in many instances for the market to recover. And what I found is it's easier to not lose than it is to wait for it to come back. Now, sure, it's a paper law. Sure, it'll come back. Sure, there's the cliches that are mentioned, and there's the things that are said from folks in my industry. But the point is, if you're 64 years old and the market goes down a dramatic, a massive loss like we've witnessed, do you have the luxury of time of waiting for it to come back before you retire? Does that mean you're going to have to put off retirement for a period of time and wait for this to come back? Does that mean you're going to have to maybe retire on less money? Does that mean you're going to have to change your goals, change your ideals, and change your strategy? Well, for some people, the answer to that question is yes. And for some people, in order to do that, you need to plug into somebody who can help you. Somebody who knows not only the financial world, but also knows the tax world, that also knows how health insurance and Medicare and all these maybe some estate planning issues that plague people in your age group. You need to plug into somebody that knows those things and somebody that has folks in their corner to be able to give you that kind of advice. And that's what we do, and that's how we do it. So that being said, that was the intro. Now, I'd like to ask you a question. How many people watching this feel the market is going to go up? How many feel the market's going to go down? How many feel they really don't know? Well, if you said the market's going to go up, you're right. If you said the market's going to go down, you're also right. And if you said you don't know, guess what? You're right. Nobody knows. Now, there are signs. There are reading the tea leaves, so to speak. And there are folks that can, on this side of the coin, there's 50 advisors saying it's going to go up. And on that side of the coin, there's 50 saying it's going to go down. If you're going to chase the market, I hope you're a young person, because the older you get, the less risk you should take. And, it's kind of like the analogy that I always use is, if you're young, you might be a thrill seeker and you may love roller coasters. But if you're 65 years old, you're not going on a roller coaster, or at least you shouldn't be. But the point is, you need to act your age. You wouldn't do things at 65 that you did when you were 20. So some people still invest that way. And unfortunately, in some instances, they're kind of chasing the same money. Now, I'm not saying the market is bad. I'm not saying the market's good. I'm telling you it's both. The point is, if anybody tells you should take all of your money and put it in X, well, that's bad. A smartly allocated portfolio consists of stocks, bonds, maybe mutual funds, exchange traded funds, CDs, money markets, some other fixed interest vehicles, and possibly gold, silver, and then of course real estate. And each of those has a different horizon of where its sweet spot is. Each of those has a different goal in mind with regard to why you would invest in them. And if you have money in a long-term strategy, that's fine. Don't touch it until the end of the long term is up. If you have money in a short-term strategy, don't be moving it around in a long-term position. In other words, people have a tendency to take all of their assets, throw it in one bucket, and kind of just gauge what's going on with the entire financial picture from everything in one bucket. Well, if you split it up into buckets that have an actual goal, that have an actual desired time frame, well, then you can, in a smart way, you can find the investments that match those buckets. And then when something like this happens, you're not going to be losing sleep, because you know that the money that you've allocated won't be needed for a long period of time. But if everything is subject to risk and you're going to retire next week, there's some sleepless nights. Okay. So what I'd like to start off with is just show you some history. If you look back at what we call the drawdown, or when the market has, in our industry, we say tanked, or it has gone down by 10% or more, you'll notice that there's this reoccurring theme every so many years, usually around 7-8 years, where the market has witnessed this more than 10% downturn. It's just the way things work. It doesn't make it bad. It doesn't make it unsafe. It doesn't make it something you shouldn't be thinking about. It's the way the market works. So if you know the way something's going to work and you think it's never going to change, well, I think we're all old enough to know that things change. And I think some of us are old enough to remember the way things were a while ago, or maybe even 6 months ago, that are going to change. That means we must change. Like if things are changing, that you must do things differently, Unfortunately, we all have to learn a new way of doing things, such as a webinar versus a steak dinner. All right. Anyway, so getting back to what I call the MAP, or in my case, I refer to it as the money access plan. You should have a plan for your assets instead of having everything in one giant bucket and having everything in one place. And then just when you're retiring, you're reaching in and grabbing out of that same bucket and it's all kind of going up and down. And you really don't know what you have. Maybe you've got, 200 different mutual funds because somebody said you need to diversify. Well, diversify doesn't mean 200 mutual funds. It means different asset classes, like we mentioned earlier. Or, maybe you hate risk altogether and everything's in CDs. Or maybe the money's buried in the backyard. Kidding. I hope it's not buried in the backyard. The point is, where you have your funds, for whatever reason right now it makes sense to you. And maybe so. But our goal is to help you make sense of what makes sense. In other words, we need to figure out what there is to figure out. I'm teasing. I like to call money different colors. So what's the color of your money? Well, there's green money, which is CDs, money market, and treasuries. There's yellow money, which is bonds and annuities, and then there's red money, which could be dividend-paying stocks or other types of securities. But the point is the money is allocated differently because the risk is different. So that being said, you don't put all your retirement money in any one of these buckets. You don't put your daughter's wedding funds or your kids' education funds all in the same because they're all different time frames. If you have a long time horizon, well, red is not so bad. If you have a short time horizon, red is not your friend. And if you have a very long time horizon, well, you're not going anywhere if it's all in green. So the point is, the first thing you do is say, okay, what are my goals? What do I have to invest? Where do I want to invest it? So you start off with another form of buckets that I call the strategy. Simply enough, there's money that I got to have where it's my principal is protected. There's money that I need for future income. There's the emergency fund. And then there's money that, I need in growth because after all, if I spend from either of these accounts, I have to replace it. So the long-term strategy of growth will replace that. So the first thing you need to do is say, okay, the money that I have that needs to have my principal protected, well, that would probably be my 401ks, my IRAs, the money that I need for income. I need to figure out what my income needs are. Okay. Sure, there's the traditional budget, which many people use and not even our government adheres to. But what I like to do is there's a form that we give everybody that tells them to list everything they're spending. Not because it's necessarily a budget, but it gives you a snapshot of exactly what's going out. For example, let's say, you've got $3,000 a month coming in and you think, yeah, okay, food, clothing, shelter, I'm spending $2,600. Well, after we do this little exercise where you're listing, well, this is what I spent on Field and Stream magazine. This is what I spent on lattes. Here's Christmas and spoiling the grandkids and going out for coffee with my friends, et cetera, et cetera. You find out I'm spending $3,200 a month and $3,000 is coming in. Then all of a sudden, when the market has a downturn and everything's in one bucket and you're realizing there's not enough income, folks are faced to go back to work, or folks are forced to work longer. I know some folks that are, 65 plus that have jobs, and it's not because they want to, but some instances they have to. So all that being said, if we sit back and say, okay, how much do I need a month when I retire? And whether you're already retired, whether you're about to retire, or whether you're not close to retiring, this is the same information that we all have to look at. What do I need a month? And we come up with that number. Let's say the number, $3,000 a month. Great. What's coming in? Well, I have $3,200 coming in. Great. We should be saving $200 every month. Now, If the wolf comes to the door and it gets tight and things get less than lucrative in a market situation like we might have now, and you're depending upon your income stream from investments, well, now you have this sheet that you could refer to and say, what can we cut out? Well, maybe we need to get rid of these $3 lattes that we've been having 3 of every single day, or maybe we need to get rid of the Field and Stream magazines. Maybe we need to get rid of cable and get one of those fancy little boxes, and I won't mention any names of them because then that would be construed as advertisement. So, but the point is, you need to be able to know what there is to cut, or how we can increase revenue or increase our interest, or cut risk. Because if you're not losing, sometimes you can consider that kind of like you're making. So here's what happens. When somebody comes to our office, we ask them to bring all of their data with them. Their most recent tax return, all of their stocks, bonds, mutual funds, IRAs, insurance policies. Bring all of the data in with us. And we're going to help you do a couple of things. First thing we're going to do is do what we call an asset inventory, because people don't even really know what they have sometimes. Sure, you have these mutual funds or you have these stock portfolio, but you really don't know what's in it, what the fees are, or if it's good, bad, or indifferent with regard to your goals, if your goals have changed. We take that data and we submit it to an organization called Morningstar that gives us a really neat report that shows us what you're invested in, what the fees are that you're invested in, what risk category you have, and how much risk you're actually taking. It's kind of like an MRI of your entire portfolio. Well, we then ask you to go on to our website and take what we call the Color of Money quiz. And it's a short little quiz that gives us a number. All right, so let's say you do the Color of Money quiz and your score comes out as a 50. Well, that means you're right in the middle as far as risk goes. You're not necessarily aggressive. You're not necessarily conservative. You're right in the middle. Well, when we do the Morningstar report on your assets, well, let's say your assets come in and effectively their score is 90. Something is not working right here. You have a score that you feel you are willing to accept for risk, but your portfolio is set up differently. When the market tanks, you will have sleepless nights because you are invested at more risk than you are technically willing to accept. So that's the first thing we talk about. Then we do an investment analysis and we say, okay, here's what you have, and this is working, this isn't working, and we suggest potentially a way to reallocate funds into a way where your map is set up, because we know your goals, we know your dreams, we know your horizons, we know your risk tolerance. It's kind of like when you go to the doctor, you have to do that triage where you got to tell them the family history, and the doctor doesn't say everybody should take the same pill. So when you listen to the news of people that tell you everybody should do X, everybody shouldn't do X. Everybody's different. The folks that are out selling books that want to tell you the market is good, the market is bad, stocks are good, stocks are bad, annuities are good, annuities are bad. Everybody has a different horizon. Everybody has a different time frame. Everybody has a different risk tolerance. Not everybody drives a Buick. Some people love Buicks. Some people don't. All right. So after we get all of that data, then we compile this cool little report. And what the report's going to show us is it's going to say, all right, over here on the left-hand side, here's what you've got. And we broke it down via this Color of Money. And this particular client in our fictitious situation here with Bob and Mary Smith, the red indicates what they currently have that is subject to risk, and the extreme risk in the yellow is the moderate risk. And over here where it says scenario allocation, that's what their goal was. That's what they want from the quizzes we've given them. So this is what they have, this is what they want, and somewhere along the line, these two things are not lining up. So we then take all of that data and we say, okay, look, you have a goal of X and your goal goes over here, and here's all the different investments that you have, and here's all the different programs, and here's your Social Security, and sure, that looks really confusing, but basically what it is, it's a very simple spreadsheet that says, here's what's going out, here's what's coming in, here's how we can make sure, to the best of our ability, you won't run out of money in your lifetime. And some people that works, some people it doesn't. But you know, we can at least give you the data. We can at least give you the report that says, here's what you have, here's what you should do, here's the recommendations that we would make. Now, when it comes to those recommendations, there's a couple of different things that you can do. And my goal right here is not to sell you specific products. I just want to give you two examples that, you know, we are not a type of organization when it comes to our clients where we recommend everybody gets the same thing. We do not recommend the same type of investments to everybody, okay? But we have access to a myriad of financial institutions that we deal with. So one of the things that we talk to clients about is something that we refer to as an equity indexed annuity. And, you know, annuities are in the news a lot. There are pros and cons to many different kinds of products. There are also many different kinds of annuities, and they're not all the same. And this particular product I like for a portion of somebody's nest egg in which they want to protect from market risk. And in this particular example from a company called Equitrust, you'll see that the green line represents the minimum guaranteed surrender value of the contract. And I'm not going to spend a lot of time on this. I just want to show you a thumbnail sketch that basically the red line is obviously the stock market, and the blue line is showing you from the period of 2000 to 2020. Of course, that's January 1st of 2020, I believe, when the market was, of course, extremely high. So the bottom line is this: when the market is kind, your money witnesses growth. When the market is not kind, you'll notice there's these downturns like we've seen in 2000 and 2001 and 2008 and 9. And we've seen these little dips along the way back in 2018. You'll notice the blue line does not go down. So there are things involved here where, you know, we would definitely have to have some dialogue to make sure you fully understand. But the general product is designed to say, when the market's kind, you can make money. When the market is not kind, there is no investment risk. There is no risk issues. Of course, there is a disclosure that must be shown anytime somebody looks at a product or we speak of a product as such. So we have this here for you to read while we're discussing it right now. It's also something that we would have to show somebody prior to them ever completing an application for the product. But for your safe money, for your money that you care that, yes, I can afford this to have market risk, this may make sense for some people, and it's a pretty interesting product when it matches up for the right person. Now, there's a little video that I want to show you, which we're going to insert right here, and this is what's going to talk about how we talk to people when it comes to managed money, or what money is left in the market. All right, so you'll see that basically with the managed money piece, as we like to call it, you can actually have your funds protected from some downside risk. Excuse me. Hit the wrong key. You can have your funds protected from some downside risk, because you would say, well, if the market goes down more than X, I would like things to change, and here's how I would like them to change. So there are some safety nets that exist, okay? I think the stock market is a great place to put your money. I also think stocks, bonds, gold, mutual funds, silver, annuities are all great places to put your money. The question is how much and which ones. And that's what we basically help you figure out. So it's not a matter of what I invest in. It's a matter of who you're investing with. Are you investing with somebody that really has been around a long time? Are you investing with an organization that has more than one entity that it does business with? Albeit TD Ameritrade, or whether it's Fidelity, or whether it's Allianz, or whether it's American Equity, or Equitrust, or Prudential, or Metropolitan. And the point is, you want to deal with somebody who has access to utilize all of those different financial institutions, because not every company has a product that fits every single person. So you want to have an advisor who is knowledgeable in all of those things. Now, the interesting thing is I want to talk to you about is when you have a financial advisor that knows a little bit more than just what's involved with stocks, bonds, mutual funds, and investments. For example, like, when should I take my Social Security? I'm 64 right now, and should I take it at 66? Should I wait till full retirement age? Should I work till I'm 70? Well, there's many different ways that this can be calculated, and we have a pretty interesting software solution that'll help you explain to you how these programs are designed at different age groups. In other words, at 66 and 3 months, if that's your full retirement age, your account will grow by, in some instances, say 7% if you waited until you're 70 or 70 and a half. There's a lot going on with those kind of decisions. We can help you because, maybe some people should take it right now. Maybe some people should wait. Once again, not everybody has the same horizon. Not everybody has the same goals, dreams, and desires. Do I need long-term care? Should I have a trust? These are all questions that we've been able to help people with. And we do it in steps. So we do it, when somebody's a client of ours, we take things in what I would call a module. Module number one is, let's get a handle of what you've got. Let's stabilize what's keeping you up at night, whatever that may be. Let's fix what seemingly may be broken. Then let's have some dialogue on how we could change things. Do I need to work on how do I transition my assets to my kids? Do I have a will? Do I have power of attorney? Are these documents current? Are they, do they need to be changed? I'm not an attorney. I'm not an accountant. I can't give tax or legal advice, but I can recognize when there might be an issue to recommend you to the specialist, because basically that's what we kind of do. Is everybody has their specialty, and they should all stay in their own wheelhouse. Accountants should do accounting and lawyers should do lawyering. That's not a word. But basically, everybody should do what they're good at. And then collectively, when you have this dream team of folks that you trust working in concert with each other, now you have a plan that's making sense. So I basically want to give you enough data to say, if you have concerns, if you have some things that you are keeping you up at night, if you would like a second opinion on what you have without an obligation, let's have a conversation. We can give everybody the free 1-hour consultation, which, obviously, if you decide you want to leave things exactly the way they are, that's fine. Hopefully we've made a friend. If you do decide you want to, come and have a chat with us, we can do it via what we call the virtual meeting, which is kind of what we're doing right now. We can use a solution called Skype, which some people are familiar with, or we could do things the old-fashioned way, and we can just talk on the phone, and you don't have to see my face. All right. So, and then anybody who wants to talk to us, there's these free offers of these 2 different books that I've written. You don't have to you don't have to book an appointment to get the book. We'll email you a copy of them. If you want a physical copy of it, we'll probably have to wait a while before we can actually meet face to face, but I can email both copies to you. Just simply shoot us an email requesting that, and then we will have a time to chat. Now, as I put up the disclaimer and disclosure, which is also on our website, I just basically want to reiterate once again that there is no There's no offer of products. There is no, you have to buy something from us. We are basically just trying to say, listen, we are a resource that have been around a very long time. We don't plan on going anywhere anytime soon. And we hope that we might be able to have a dialogue. Maybe we can help. So, with that being said, until we get a chance to actually speak, we wish you well and stay indoors. Take care.